Hello and welcome. You're watching The Money Show, your one-stop destination for all your personal finance queries. I'm Kavita Thaplayal, and today, once again, we'll be talking about your financial portfolio and your financial strategies for your financial goal. Just in case you want to get your financial portfolio checked by our experts, all you have to do is just send across your questions on our WhatsApp number and email ID. That's right, the WhatsApp number is 8657974571. The email ID is themoneyshow@etnow.tv. So the only show where we do your life financial planning. So let's begin, and a very crucial topic, in fact, in terms of diversification, a very interesting asset class that can be included in your portfolio. Today, we dive into asset class that's gaining traction but still flies under the radar for most retail investors. That's right, I'm talking about InvITs or Infrastructure Investment Trust. Imagine earning regular income from roads, power lines, or highways without owning any of it directly. Sounds niche, right? But it's not. With market regulators now making InvITs more accessible, should they be a part of your investment portfolio? We break down the risk, the rewards, and the real returns right here, right now. InvITs offer stable yields and infrastructure exposure, but are they truly fit for the average retail investor, or are they still best suited for the institutional elite? Let's deep dive. I have with me Shweta Rajani from Anand Rathi Wealth to elaborate more on this today. Shweta, hi, good evening, and welcome to the show. Let's talk about InvITs. I'm sure a lot has been already talked about, but then let's get into the nitty-gritties. And from a retail investor's point of view, definitely I want to understand what exactly is an InvIT and how is it different from a mutual fund or a REIT?
Good evening, Kavita. A very interesting topic, though, because of lately we've heard the regulator, the market talking a lot about InvIT and REITs. So let me, in very simple terms, explain what an InvIT is. The bigger name being Infrastructure Investment Trusts, and as the name goes, what it means is that a company, let's say something like an NHAI, right, National Highway Association, would pull in money from various investors and invest that whole money into an infrastructure project. It could be a company coming up with an InvIT for, let's say, building a highway. It could be for renewable energy, it could be for power, but these are basically monies pulled together to invest in large, long-term infrastructure projects. Also explaining the concept of REIT, which is nothing but real estate investment trust. Real estate does the same thing as an InvIT, except that it would invest in real estate projects, mostly commercial projects, from where they could derive income in the form of rental income. In an infrastructure investment trust, because they are investing in, let's say, highway projects, they would be focused on building the highway, and therefore at a later stage also getting the income from, let's say, the toll income. So what you earn as an income from a REIT or an InvIT, it would mainly be your dividend income, your interest income, and capital gains that would arise on the increase in the price of the InvIT. So that is InvIT for you.
All right, let's break this down further because, we are also talking about having infrastructure as a sector allocation already through mutual funds. That is also a great benefit that that our investors get, because a mutual fund as a product is a bouquet, where you get everything as far as investment and equity is concerned. We get infrastructure exposure over there also. We get that exposure in a large cap fund. We get that exposure in a sector specific fund also. Now, why do you think one should be going for InvITs in this kind of a scenario where you already have an exposure?
Correct. So, infrastructure as such is a very wide sector, and it has a lot of subsectors if you look at it. So, where InvITs focus on is they focus on building that particular infra. Could be, like I said, it could be about building that highway and getting the benefit from that one project, one or two projects that may be a part of that InvIT. Whereas if you participate in a mutual fund and through that, the infrastructure exposure that you may be getting would be in that particular company is all projects put together. So you're not focused on just one, one highway or, one or two renewable projects of that company, but all the projects put together. Plus, when a mutual fund looks at infrastructure, they're looking at not just the project itself, but everything or all the ancillaries that go in and around it. So, for example, it'll also have capital goods, it'll have cement, it'll have building materials, all of it that would form a part of what you call as infrastructure. So therefore, if you want to just get the benefit from a specific project, then InvIT is the route for you. But if you want to benefit from the sector as a whole,
All right, I think there is some technical issue going on over there from Shweta's end. But then, in a nutshell, it's a great. Okay, I think she's back with us. Shweta, can you hear me? You can continue.
yes, I can. So I was basically saying that if you want to participate in a niche project, then it is the InvIT route for you to go. But if you want to benefit from the infrastructure development as a whole, then mutual fund is the route for you to go. And mutual funds are also allowed up to 10%. They can invest in REITs and InvITs. So indirect participation to an InvIT is something that you may get when you are going in for a mutual fund route.
Right. One very important question, because we want to understand the market and regulatory insight also, and several changes. We are seeing the regulator also trying to make it more investor friendly, whether it being, the entire AIF category, you talk about REITs or InvITs. Now, talking about the changes and making it more investor friendly, how has SEBI's regulatory push made InvITs more accessible to retail investors recently? Also, do you think InvITs can become the next big thing in the portfolio when it comes for diversification, for Indian investors? And also, I like to add one more question to this. Minimum investment thresholds, which are lowered now. Do you think there's going to be a significant uptick as far as retail participation is concerned in listed InvITs? Shweta, I think I asked you three questions. You can take it one question at a time.
Sure. The regulator is definitely pushing in for, making increasing the participation for InvITs, REITs altogether, by lowering the investment requirement, by increasing the liquidity. So a bigger challenge, let me highlight over here, when you invest in InvITs, is that they have low liquidity. So just to give you, some data points over here, there are some 26 odd InvITs which are registered with SEBI, but 17 of them are listed, the rest of them are unlisted. But if you look at the trading volumes, if I just pull out, there would be hardly 8 to 11 InvITs that would have been traded in the last 1 month. So that's the challenge also, which the regulators trying to highlight and improve on by increasing the retail participation, by lowering the limits allowed to retail, making it more accessible to them. Also proposing for mutual funds to go ahead and probably increase their allocation to InvIT, so that the broader participation goes up. But yeah, there are challenges today as we speak for someone who would want to invest in and InvIT, that in case you want to liquidate it, the liquidity may not be as high as T plus 2 or T plus 3 as you get it in a mutual fund. That could be a challenge for you. So definitely regulator doing its job. But if you ask my perspective, I would say for a retail, keeping the liquidity as well as the volatility aspect in mind, a mutual fund route to get some indirect exposure to InvIT and infrastructure may be a better route to participate than directly going in for an InvIT. Yes, if you are, and HNI, Ultra HNI, willing to take a slightly more risk, does not have a liquidity concern as such, may still consider putting in some allocation. However, if you do comparisons between, what your risk adjusted return could be, they don't seem that attractive.
Mm-hmm. Exactly. So I was just coming down to the question on returns only, because you know what happens is anywhere you invest, even if it's for the purpose of diversification, you do expect some kind of a return. So, you know, what kind of returns can a retail investor realistically expect from an InvIT, and how stable are these payouts? Because we're talking about infra projects, they are long-term projects. Sometimes the projects are stalled, you know, because there's a lot of political factor also involved in these kind of projects, right, Shweta? So how can one go about it in terms of expectations on the return front?
Absolutely. I've done some study on how the returns have been, and therefore, if you look at it in the last 1 year, there definitely has been some improvement in, the projects moving smoothly. Therefore, the payout in terms of your quarterly or monthly interests coming in improving. But if you look at the longer term track record of InvITs, if I'm just talking about, let's say the 3 year return of the InvIT index, which is there, which is published by NSE, that's delivered around 1.25% return as compared to a Nifty 50, which would have delivered around a 15% return. If you look at it from a 1 year rolling return basis, because you look at an average 1 year holding period, even over there, if I look at it, InvITs have delivered around 10.5% return at a time when Nifty 50 would have delivered around 18%. And the risk levels are not very different. It's, a standard deviation of 6 on InvITs versus a 9 on the broader Nifty 50. I'm not even talking about a well diversified mutual fund portfolio where the returns could be enhanced a little more than this. So, purely from a return and risk basis or return to risk basis, uh, it is not making sense to be in an InvIT. Having a diversified portfolio may actually give you more optimal risk adjusted return.
Since we are talking about returns, let's also talk about the risk factors that one should be keeping in mind. So, how safe are InvITs? I mean, although we have a regulator, it comes under all of that. But still, when we have to talk about considering risk, you know, should an average investor be aware of, especially post-COVID and, you know, rising interest rate scenario that we saw, and now the scenario is completely, you know, it's on the rate cut that we are entering into. What could be the risk involved, and accordingly, should we not exceed more than 10% of our portfolio exposure?
Absolutely. So, two, three risks that I would have to highlight for someone investing in an InvIT. One is the liquidity risk. They are low on liquidity. Second is, see, these are listed, some of them, and therefore you can see the price movement. So the price volatility also is, like I was just mentioning, like a diversified Nifty 50 basket. So it's not that they're giving me a lower volatility. The third risk is delays in projects, which could mean projects getting stalled, projects getting delayed, and therefore the return that comes to an investor in the form of interest or dividend could also get compromised. There could be periods where they don't get it. Like you highlighted, the interest rate scenario is changing, so what they would be getting as payouts earlier versus what they could get now would all differ. So these are few risks in terms of allocation. Just to give you some numbers, mutual funds are allowed to invest up to 10% in REITs plus InvIT. If I look at what their current allocation is, that's around 3% of the overall money that's invested in this segment. Just taking a perspective from there, I would say if somebody is keen on getting an allocation, maybe not more than a 5% allocation for the overall portfolio, for those who want something very different. So it can be anywhere between 0 to 5% in a portfolio.
All right. I just want to understand few things, you know, as far as the exposure is concerned in the infrastructure projects. Are power transmission InvITs riskier or more rewarding compared to a road or a telecom asset InvITs?
So, just like I told you, there are some 17 odd InvITs which are listed today. So, if I look at the breakup of that, almost 11 of them are road projects, road highways put together. There are some two projects which are on the power transmission side. There are around three projects which are running right now, which are on the energy space. So if I look at it from that standpoint, where is the place where there is high liquidity, where more opportunities coming in, and therefore from a return standpoint, what has been reasonably better than the other one is clearly this segment of road and highways, then followed by power. But clearly, in terms of sustainability, in terms of consistency, uh, power again takes one step below what it would be for roads. So if I have to see from that standpoint, if someone is participating in an InvIT, then investing in an road project based InvIT may be a better choice.
Uh, Shweta, you've already answered this question, but I still want to, want you to elaborate on this because these are critical questions. Although we're talking about steady income, we're talking about a diversification, we're talking about project-wise diversification. But if you are someone who has an InvIT, there is a delayed project or an underperforming asset, this will be a dent in your income, right? What do you do then?
So clearly, one option is that you have a very small allocation of your portfolio to InvITs. If you need, you can, like I said, also have InvIT REIT in your portfolio and go the mutual fund route. That would work better in terms of if you have any liquidity requirements, do your SWPs and very comfortably get your monthly, quarterly requirements that you would have of liquidity from your mutual fund portfolio than relying on one specific project, which runs a very high risk. Second is, keep constantly looking at the liquidity situation. REITs and InvITs are listed, and therefore, if you feel that you need to liquidate a portion of the portfolio, you can consider doing partial withdrawals from there as well. Anyways, from a tax standpoint, if you look at it, these are so to say, they have equity taxation, so they become long term after a year, and they'll get the benefit of the long term equity taxation.
Right. So since we're talking about exiting an InvIT, so we should be assured, Shweta, that InvIT is the liquidity is taken care of in the secondary market for these units.
So right now the liquidity, like I said, is not very high in this segment. So if I have to just give you one example, then there are 17 InvITs which are listed if you go to see. But if I look at the trading volumes for six of them, the trading volume would be where more than 25% of the free float was traded in the last 1 month. So yeah, you are compromising on liquidity when you are investing in InvITs. Don't expect that you would get your money in T+2 or T+3 basis. It could take a week, 10 days for you to liquidate from a good InvIT in your portfolio.
All right. Now, one last question to you, and then we'll move on to our question answer session, Shweta. Now, how transparent are Indian InvITs when it comes to disclosure, asset valuation, and cash distribution? As an investor, do I have all of these information already in public domain?
See, most of them do publish these details, but they would not be as transparent as a mutual fund fact sheet would be for you, where you get the details of all the companies. Some of them do share out detailed investments, but in terms of transparency, if I have to rate it, I would rate it maybe a 5 on 10. So there could be challenges where you may not get the entire detail, especially if you're not invested in it. If you are an investor, then you may be getting regular updates on the investment. But if you're evaluating, then you may not have access to complete detailed breakup of which project, how much, what's the status on that.
Shweta, one more question. Now, do you think one can also go through an AIF route for InvITs? Is that recommended?
So, are there options in that segment? Yes. Is it recommended? I think I would not recommend, being in that segment, because here again, AIFs do have their lock-in, and, there are costs which would be higher than directly participating in an invest. The management fee that you're going to pay in an AIF clearly would be way higher than if you are a retail and just wanting to take an InvIT exposure. So from that standpoint, it again is not recommended. The product, the investment per se, like I said, if you want to benefit from infrastructure, going through that MF route, which is far more diversified, has a proven track record, is also indirectly participating, maybe just 2-3%, but getting the benefit of that InvIT if it is so attractive, evaluated by a fund manager. That may be a better route for you to be, rather than going in for an InvIT directly or an AIF which is investing in an InvIT.
All right. I think with that, it's a wrap as far as discussing InvITs is concerned. And for all the viewers who want to know more about this particular asset class or investment option, what you can do is just send across your question on our WhatsApp number and email ID. I'm just going to have that thing flashed on screen so that you note it down. The WhatsApp number is 865-797-4571 and the email ID is themoneyshow@etnow.tv. So if you want to know more about InvITs, feel free to send across your question on this WhatsApp number and email ID. All right, let's carry on with the show and time to get your portfolio queries answered by Shweta. Shweta, let's take Tanvish's question and a couple of funds that he's already investing into. He has Nippon Small Cap, Tata Small Cap, Quant Small Cap, Motilal Mid Cap, HDFC Mid Cap and Nippon Large Cap. Wants to stay invested for 20 years and he's not given me the corpus amount that he wants to accumulate.
Sure. Tanvish, like we mentioned in all shows, the step up that you can do to your SIP would only give you the best compounding effect. So if you can have a step up of 10% every year, please do so. Coming to your portfolio, clearly a mid, small, heavy portfolio, probably recency bias playing out where you would have seen good returns in the last maybe 1-2 years and therefore built a high, mid, small, but you need to bring this down. Second, you have too many schemes from Nippon. 1/3 of your money is getting invested in that one AMC. So some suggestions that I have: you have 3 small caps, continue with Nippon, exit or stop your SIP in Tata and Quant small cap. You have an HDFC mid cap opportunities. There again, you can stop your SIP and continue with the Motilal mid cap that you have. Few funds that you can add to your portfolio because you need to have a higher large cap allocation. I suggest you go in for a DSP large and mid cap, an ICICI Pru dividend yield fund, and maybe a Kotak multi cap can be added to your entire portfolio.
All right, so that's the solution for Tanvish. Now I have Mr. Venkata Ramadu on the phone line with me. Hi, good evening, sir. How are you doing today?
Yeah, good evening.
You're calling from?
I'm calling from Andhra Pradesh.
All right, sir. Thank you so much for sending us your question. So you want to invest around 30 lakhs, is that right?
Yes, yes, correct.
So for how many years would you want to stay invested?
No, actually, I'm a retired person. I want to invest
Sure,
at least
okay.
for 5 years, next 5 years.
5 years, okay. So are you
Yeah.
aware of the risk associated with equity as an asset class?
Yeah, I know.
Okay. You won't be able to take much of risk. It's going to be a conservative hybrid strategy if we recommend. Will that be okay with you?
It is okay, madam. Actually, already I have some mutual funds around 1 CR.
Oh, you already have mutual funds. I don't have those details, sir, because what will happen is if we suggest something new, it should not be a repetition. So maybe when our expert Shweta Rajani, when she recommends the funds to you, you can just go back and cross-check if they are repetitive, because this is going to be a different strategy for 30 lakhs that you might be opting for. Is that right?
Okay.
Okay, so all right, so let's begin. Shweta, what do you recommend? 30 lakhs and 5 years time frame is what he wants to give to this investment amount.
Sure. So as I understand, you are already a mutual fund investor. I just want to reiterate one thing. Given your age, time horizon of 5 years, do keep in mind your asset allocation. If you need to have some debt in your portfolio, which you would, please do have that. Don't have your 100% maybe in equity, given
Okay,
the
got it.
time period. Giving you a suggestion of 5 to 6 funds. You can go in for an SBI large and mid, Kotak emerging in your portfolio, HDFC small, ICICI Pru dividend yield, and Canara Robeco multi cap. What I'm trying to do is have a blend of different investor fund manager styles and have around 60% of your portfolio, which would be large cap, and the rest of it towards mid and small. So that was the strategy in my mind when I told you this basket. But please go back and look at what you already have and look at it holistically for your portfolio.
Mr. Ramudu, do you want to ask anything else? Are you good with the
madam.
recommendations? So, yeah.
No, one,
Yeah.
one more thing. Actually, I have
Sure.
nearly 20 lakhs in SBI Energy Fund. Shall I continue or
SBI. Okay.
SBI Energy Fund?
SBI Energy Fund. Okay. Do you need the money right now? No. You want to stay put like for 5 years?
But it is not performing well. Right now, money is not required. But for the
Yeah,
last
it is
1 year,
not
it is not
performing well.
performing.
That's true. That's true. Shweta, what would you recommend? 20 lakhs. Hefty amount there.
Yes, so if I look at your overall portfolio of 1 CR and then 20% is allocated to a single scheme, which any which ways is not a good strategy to have, right? Generally, Venkat sir, not more than 10 to 12% should be your allocation to any single scheme. And more so, if this is a sectoral fund, then you probably should have a lower allocation and only be in those sectors which you understand and you're tracking it very closely. And some of these sectors, if they are expected to do well, of let's say an SBI large and mid cap, also the fund manager will go overweight that sector. So my suggestion to you would be that you exit from the energy fund and spread it out across the funds that I just told you. And as a hygiene factor, please don't go beyond max 15% to any single scheme.
All right. I think that's a solution for Mr. Ramudu, and all the best with your investments up ahead, sir. With that, it's a wrap on the show also, Shweta. Thank you so much for taking time out and helping our viewers with their strategies in InvITs and also answering their financial portfolio queries today. And for all our viewers, I'm going to leave you with our WhatsApp number and email ID so that if in case you want any strategy advice or recommendation from our experts, you can send across your question on our WhatsApp number, which is 865-797-4571. The email ID is also there, the money show at etnow.tv. Send across your question with all your financial details and we will help you achieve your financial goals. Thank you so much for watching. Goodbye.